So today, the key is how are we going to find, finance, and secure your first multi-let investment? And the agenda is quite simple. Step 1, how to find and analyze a deal. Number 2, the due diligence checklist. And that's a critical piece of knowledge is what steps can I take to verify or validate that my deal is actually a good deal? And then we're going to talk about securing it with an offer to purchase and then financing, what options you have. And then finally, I'll do a quick live case study of a deal that I'm currently working on and just show you the steps that I've taken. Okay, so first of all, how to find a multi-let investment. There are two key things that you have to be looking for. The number one thing, location, location, location. You know, every estate agent talks about that. And when you're looking at a property multi-let investment, you want to be in the lower income areas. You want to be in highly dense city centers, and your gross yield needs to be a minimum of 15%. Obviously, if you can get a higher gross yield, that's just more opportunity for you to make money, but a minimum of 15% when you're looking at multi-lets. So as you guys know, I'm a very big believer in the Joburg South area, the Rosettenville, Kenilworth, Turffontein side of town. Reason being is that it's lower income, it's close to the city, it's close to a center of town, and it's got gross yields of 15 to 20%. If you're looking more in the north of Johannesburg, you're looking at areas like North Riding, Blobusrand. Those areas could potentially work. You obviously can make this work in CBD areas in Johannesburg. When it comes to Cape Town and Durban or KZN, I have yet to find the right multi-let areas. But if you follow the principle of lower income, close to city center, and the gross yield is 15% plus, that's an area worth exploring. The second is motivation. Now, I talk about this a lot in other videos, but you make your money when you buy. You make your money when you get a discount on the asking price. Now, my sort of ballpark figure that I try and get is between 15 and 20% discount. Obviously, we all want 100% discount, or we want as much discount as we can get. But there is a balancing act between how much discount you can ask for and the person just saying no or yes. And I found that if you're going for about a 15 to 20% discount, you usually have a relatively successful chance of getting the person, the seller, to commit. So that's really about finding the right area, location, number one. Number two, you have to find a motivated seller. Now, once you've found, let's say, your area and you've found a few sellers that are motivated, the next question is how do you go about analyzing a multi-let? The two key components that you need to look at here are your cash flow on one hand, your return on investment on the other. Now, for those of you who don't know what a multi-let is like a buy-to-let. So it's like buying an apartment and renting it out to tenants. But instead of buying one apartment, you're buying multiple. You're buying 6 apartments in one go as opposed to one apartment. That's the only difference, really. Another example of a multi-let is when you buy a house. Let's call it a 5-bedroom house, and you rent it out to 5 different tenants. So each room gets quarantined for a person. So kind of like a student commune is an example of a multi-let. Now, the first thing we have to look at is cash flow, which is just a fancy term for monthly profit, right? So here's an example of a cash flow statement. This is the first apartment that I ever bought. The asking price was $850. I got it for $645. Nice discount. Remember, your discount. That is where you make your money in property. The rental is 10,000 Rand. This is a 2-bedroom apartment in Fourways, which is in Johannesburg, northern suburbs. The bond is 5.4. Levies, rates and taxes, and essentially after all of my expenses are paid, I'm left with 1,500 Rand in terms of profit. Now that is what we call your cash flow. You've either got a positive cash flow or you've got a negative cash flow. Positive cash flow means you're making a profit every month. There's more income than there are expenses with your property deal. That's considered an asset because it's putting money into your pocket. A negative cash flowing property is one where the expenses exceed the income and you're left with a loss every month. Now that's a negative cash flow property, or what I refer to as a liability. If it's not putting money into your pocket but taking money out of your pocket, it's not an asset, it's a liability. And sometimes I think, especially in South Africa, we get taught that you got to buy a property, and for the first 7 to 10 years, you're going to have to pay more into the bond, or you're gonna lose money every month. That's the common thought, the common belief. But I disagree. I think if you can get a good enough discount, you can make cash flow from day one. You can make profit from day one. So the first thing that we have to be looking at when we're analyzing a multi-let deal, does it make positive cash flow? Okay. Now, once it does make positive cash flow, we're going to use this calculation called your return on investment to make a buying decision. Okay. Now, your return on investment is a very simple calculation. It's the profit that your property is making, so the monthly cash flow, divided by how much money you took out of your pocket and put into the deal, times 100. So let's look at a buy and hold example. Let's say you're making 2,000 Rand per month off an apartment or a block of flats. So you're making 2,000 Rand per month. The first step is you have to annualize that cash flow. So the 2,000 times 12 gives you 24,000 Rand. That's the profit that you're making annually on this specific property. And then the money in the deal. Now, guys, the money in the deal is not the money you're leveraging from other people. If you're getting 100,000 Rand loan from the bank, and you're getting 1 million from a private investor, and you're getting, maybe another financier to give you another 1 million, that's not your money. The money that we're talking about here is the money you have to take out of your bank account or your pocket to actually make this deal happen. So for instance, let's say you get a 90% loan to value. The bank says, here's 1 million Rand, or there's 1 million Rand property, we'll give you a 90% loan. The bank will give you 900,000. You have to come up with that other 100,000, the 10% deposit. That's your money, right? So usually your deposit will be money you have to put down, your transfer cost, your bond registration cost. Maybe you have to renovate the property. Those are fees that most likely the bank is not going to finance. Okay. So here I've got a quick example. Let's say your deposit is 80,000. You've got 30,000 in transfer costs, 90,000 in renovations. So you're in the deal for 200,000 of your own money. The rest has been leveraged from the bank. Your return on investment is profit divided by 200,000 times 12 gives you 12%. And the way you have to look at that 12% is compare it to whatever you're getting at the bank. The bank is a risk-free or mostly risk-free investment. And let's say you're getting 6% interest in your money that you've got saved in the bank. If this property deal is bringing you 12%, what that's basically saying is that if you took your money out of the bank, out of that 6% interest, and you put it into the property deal, the money you're putting into the property would work 2 times harder than it's working in the bank, right? Because 12 is double 6. So if you're getting 6% in a risk-free bank account, and this property is willing to give you or able to give you a 12%, you can now ask yourself, is the risk of taking my money out of a safe asset like the bank and putting it into a property investment where there's more risk but there's more return, am I willing to take that risk? Does that make sense? Right? It's always a balance of risk and reward. So cash flow must be positive, step 1. Step 2, return on investment tells you how hard your money is working for you in comparison to the bank. So the calculation is really simple. Your profit divided by money invested times 100 gives you your ROI percentage. The due diligence checklist. Okay, this is key. Your outputs are only as good as your inputs. What I mean by that is if you run the numbers on a deal and it seems brilliant, you're getting a 20% return on investment, you're blown away and you said, greatest deal of my life, but the inputs into that calculation are incorrect, you've wasted your time. What I mean by that is if you're calculating your rent on 10,000 Rand, but in reality, you can't actually get 10,000 Rand, you can only get 7,000 Rand, then your return on investment calculation is a waste. You need to be using what I call actuals. You can't use estimates, you have to use the actual data to make an informed decision. So when I'm looking at a multi-let, and I'll show you just now with this live deal, there's certain things that I need to check off, there's certain things that I need to double check. So here are the steps, right? First of all, run the numbers. I use myapp.property app for that. You can use an Excel spreadsheet or whatever you choose. Do some area research, which is most likely a TPN report. Get proof of income, proof of expense. View the property, question the tenants, and then get a renovation quote or get a building inspection done on the property. Once I've done those 6 odd aspects, and I feel comfortable and confident with all of my due diligence, then I'm ready to make a buying decision. Okay, does that make sense? I hope it does. So running the numbers, go and check out myapp.property app. You can work out your gross yield, your return on investment, your rate of your return, and your exit strategy. I don't want to spend too much time on the running the numbers. I've got plenty of videos on the YouTube channel for running the numbers. If you're confused about that, please just go and check that out. TPN, when you're doing area research, TPN is one of the best tools that you can use for multi-let information. TPN provides you with information regarding the area's risk, the demographics, the affordability of your tenants. So TPN can tell you, what the price band is of the tenants in that area. How much are the average tenant earning? What is the risk of the tenant not paying? What are the expected escalations that you could get year on year in terms of your rent? So this is an example of not using an opinion, but rather using fact. So don't listen to what the estate agent says. If the estate agent says, yeah, you can easily get 10,000 Rand on this property, go and double check it with TPN. Go make sure that there's some data to back up that claim, because your output of your ROI is only as good as the inputs of each variable that gives you your ROI. Okay, TPN is a great source. Proof of income and expense. Here's an example. On the left, you can see a proof of income. That is a rent roll that shows you what each tenant within this specific multi-let is paying. And on the right-hand side, you've got a COJ or a utility bill. So this is a copy of this specific multi-let COJ account. It's got the City of Johannesburg label on the top left. Obviously, I've cropped it out, but it's what you can see here are actual numbers. And again, the output of your return on investment calculation is only as good as the inputs that you put into that calculation. Okay, so proof of income and proof of expense, guys, is critical when analyzing a multi-let. Next, you want to be viewing the property. Now, this was a couple of days ago. I went with one of my students, Thierry, and we went to go and look at this multi-let. This is a block of 40 units, and on paper, this deal made a lot of sense. It seemed really good until we went into the property, and we realized that there were about 12 vacancies in the property, and the kind of tenants that were living there were, let's just say, more on the rough side. So viewing the property is really important because you get to meet the tenants, you get to get a sense of the area, you get to look at the renovations that are required. So viewing the property is a very, very important part of doing your due diligence. The next step that I would definitely recommend is questioning the tenants. Now, when you're buying a multi-let, you're most likely going to buy it with tenants already in the property. Or at least most of the units will be filled with tenants, or most of the rooms. And the tenants have no reason to lie to you. Right? Like, if you ask an estate agent, what's the rent on this property? The estate agent might, what's the word? The estate agent might overinflate the value of the rent because they want you to make a decision. So although the rent is maybe 5,000-6,000 Rand per unit or per room, they might say it's 7.5, because they want to incentivize the deal. They want to show the value of the property. Okay, I'm not saying that estate agents lie, but if you're driven by commission, you tend to say what you think the person needs to hear to make a decision. The tenants, on the other hand, have no reason to lie to you. So some of the questions that I will ask a tenant is, first, how long have you stayed here? If you've stayed here for 3 months, 6 months, then I don't really know if you're a good tenant or a bad tenant. That's a risk. If I know that the tenant's been there for 5, 6, 7 years and their payment history is pretty good, I'm thinking to myself, that's an asset. That means this is a low risk building because I've got a great tenant that stayed there for long. Are you employed? Also a key question, if they're not employed, well, how are they going to afford the rent in the future? If they are employed, how long have they been employed and where? And then you can always phone that employer and say, look, I spoke to John and he said that he works here. I just want to confirm that he does. Right? Because what you want to do is you want to de-risk yourself as much as possible. And the biggest risk in multi-let is your tenants. Anything you want to change? That is a great question. Any renovations you want done? Is there something not working? Is the plumbing working? Is there some electrical faults? Do you want to repaint? How safe is the area? Do you want more security? Now that's all going to feed into your renovation quote. And if you've got a very big renovation budget, that gives you the ammunition to go back to the estate agent and say, look, I wanted to offer 2 million rand, but look at how much work needs to be done. Right? This tenant complained about plumbing. This tenant complained about damp. This tenant complained about electricals. So my renovation budget is 200,000, which means I'm going to have to reduce my offer price by 200,000 to make up for that. So it's a great way in which you can then begin to negotiate more with your estate agent. Do you feel safe? If your tenants don't feel safe, that means it's a high risk area or that there's a potential for a break-in. That's a risk. You got to decide, are you okay taking that risk or not? And then probably the most important question that I ask is, would you recommend your friends to live here? And if the answer is no, well then why not? What's wrong with this place that you wouldn't recommend it to a friend? And that will hopefully open up some great dialogue between you and the tenant to figure out why this investment might not be a good investment. Because remember, the estate agent's job is to show you how good the investment is. They're going to do everything in their power to show you only the good points. You need to use the tenants to help you see what the bad points are, and then you can balance the bad and the good and say, yes, there's risk in this deal, the reward is in this deal, yes, I'm ready to make a decision. Okay. Then, securing the deal with an OTP. For those of you who don't know what an offer to purchase is, it's a legally binding document that binds the seller and the buyer to certain terms and conditions. It must meet suspensive conditions for it to be valid. Now, what that means is you can exit any offer to purchase or any legal document if a condition that you've asked for is not been met. So for example, one of the conditions that I like to do is, let's say I'm looking at a multi-let and there's one bad tenant, a tenant that hasn't paid for 3-4 months. I will put in the contract, in the offer to purchase, I'll say, my offer of 2 million is subject to the current owner evicting that bad tenant. So what I'm doing is I'm making sure that the eviction process is not my problem. If the seller wants to sell to me, they need to evict that bad tenant. If they don't evict that bad tenant, I can walk away from the deal. Another one would be subject to finance. Right? That's a very common one. Subject to getting a 90% loan from Absa Bank. If Absa says they're not going to loan you the money, you're out of the deal. And you just walk away, no questions asked. Another one would be subject to getting the building inspected, or subject to getting a builder to quote me on certain aspects. And if the quote fits my budget, I'll move forward. Another great one, the most common one that I use, is subject to a 2-week due diligence period, where if I find anything wrong within those 2 weeks, I can leave the deal. It's a very open-ended statement and allows me to get out of a deal. Okay, and then finally, raising finance using other people's money. Now, the challenge with multi-lets, guys, is the banks aren't going to touch them. Your normal banks, your ABSAs, your FMBs, your net banks are not going to touch multi-lets for a variety of reasons. So you're going to need to go to other commercial type banks. So the two that I have in mind for you that I'd like you to write down or make a note of is number one, TUHF, TUHF. They focus on urban developments and they are very good at investing with property investors. They will most likely loan you 70 to 80% loan to value at prime plus 3 plus 4. And then you've got combined finance. So they do a lot of the financing for me in Rosettenville. They provide you with 70% loan to value at prime plus 1. So there are options out there, but what I can say is if you're looking at the multi-let strategy, you need a bit of capital. Unfortunately, if you don't have capital, there's lots of other different strategies like your sourcing, your rent to rent. Those are or your back to backs. Those are strategies that require almost no money. But your multi-let, you're going to be needing 300, 400, maybe 500,000, depending on the size of the deal. You can get financing of about 70% of the value of the property, but you do need some cash. Okay, so we've done a little bit of the theory now. I want to show you a practical application of the theory through a live case study. And I thought the best way to do that is to take you through a deal that I'm currently working on and just show you the steps of what we've done. So here is a live case study of a property in Turffontein. I can actually quickly open it up here on property 24. So let me just get it here. So this is the property. It has been secured with an offer to purchase already, so yeah, there's no point in you guys trying to put an offer in as well. But this is the block. It's pretty nice. It is going for 2.8, 9 2 bedrooms, whole bunch of information there. So the steps that I took with this specific deal is: number one, find the deal, right? Do the due diligence, run the numbers, secure it with an offer to purchase, raise the financing, and then managing the properties. Those are the 6 steps that you're going to need to take when looking at any property investment opportunity. So step number 1, find the deal. How did I find it? Property 24. Okay, as simple as that. A tip that I can give you is when you are looking at the likes of a property 24. So what I would recommend is if you're looking for your multi-lets, choose the filter here under property type. Choose the filter as commercial, because a lot of multi-lets are defined under the commercial tab, or alternatively you can go house, and I would put the bedrooms to 5+, because then you're looking at a big house, and a big house is the kind of opportunity where you can do multi-lets. So here, for example, you can see there's a bunch of different multi-lets. Here's a 10-bedroom house. Here's another 6-bedroom block of flats. So that's how you would find a multi-let. Alternatively, you want to be speaking to estate agents, right? Now remember the first thing that I said: when looking for a deal, you need location and you need motivation. Now the owner of this specific property has some severe medical bills that they need to pay, and therefore they need to sell urgently, and that's the reason why they've accepted the offer that we've provided. Step number 2, due diligence. What steps can we take to make sure our inputs are correct? Because our inputs affect our outputs. So the first thing is viewing the property. So this was the property that we viewed, was about 2 weeks ago, 3 weeks ago. The area is probably not fantastic. It's in a maybe a higher risk area, but there is a school. What you can see there on the left, that is a school. That's always a very positive sign for me, because well, families are attracted to areas with schools, right? So I'm hoping that a good, decent number of those tenants will be families with small kids that will then have good jobs to pay off their rent. So step number 1, view the property, make sure that you're happy with it. Proof of income, right? So here's the rent roll and annual financial statements. Okay, now with this specific deal, we were able to see the rent roll, which is very common, but we were also able to see the annual financial statements of this specific block for the last year, which is fantastic. That doesn't happen very often. So what you can see here, there by the red, is in the year 2020, they made a total revenue on this property of 421,000 Rand. Now, if you divide that by 12, you get a number around 35,000, which, if you can see where this arrow is pointing, confirms what the rent roll is saying, where they're expecting 35,720 per month from their tenants. So here is an example of not taking the estate agent's word for it, but rather confirming what the estate agent said with some documents that prove. Right. So we've got the rent roll that proves 35,000. We've got the annual financial statements, which again prove 35,000, which is great. One thing to note here, guys, which is also quite interesting. You can see here that from 2009, the revenue generated was 430,000. In 2020, the revenue was 420,000. What that means is that there was zero escalation in the rent. They made the same amount of rent in 2019 as they did in 2020. So when you're doing your future projections and you're saying, okay, in the next 10 years, we think this property is going to look like this, you've got to see that the escalations might be quite low, because for the last 2 years, there hasn't really been much escalation. Proof of expenses, also very important. So the utility bill, guys, you have to get this for every multi-let that you buy. Make sure that you get the COJ or the utility bill account. It tells you what the rates and taxes are, the water, the electricity. It gives you all of that information. I was also able to get the specific power bill, so the electricity consumption of this property, and the insurance premium. So this property's insurance is $1,400, which is quite high. I could probably use my own insurance broker and get it a bit lower. But it's important for you to see actuals, because remember, I'm going back to that statement every time. Your output of your ROI is only as good as the inputs in the calculation. Another aspect of due diligence is to do a building inspection. I recommend that you use these guys. They are called the Gauteng property inspectors. I've used them once or twice, and my experience with them has been good. If you've obviously got your own contacts, please feel free to use them. But what I would say is, if it's going to cost you 10,000 Rand for someone to go and inspect the property and check the roof and the trusses and the damp issues and give you a comprehensive view of what's good and bad about this property, that's worth the investment. If you're going to buy a property for 2 million Rand, pay 10,000 Rand to someone with experience to go and look at what's all broken in the property. Next would be reports, right? So I did pull the TPN reports. I could see what the average sectional title property value was and how much volumes was being sold. Here you can see all the red areas in terms of tenants, risk, payment profiles. So I know now which areas are high risk, medium risk, and low risk. The thing is, I don't believe in avoiding the high risk areas. You just need to make sure you factor the high risk into your numbers and you still get a good enough return on investment. Does that make sense? All right, it's fine. It's fine to invest in a high risk area as long as your money is working really hard for you. And just getting confirmation, the estate agent told me that you can get about 4,700 Rand per month per unit. And you can see here on the left, the sectional title property, the average rent band per sectional title is hovering there around 4,700. So all you're doing here is you're confirming and using actuals so that your inputs are accurate, meaning your output will be accurate. Third step is to run the numbers. So we've viewed the property, we've done the due diligence, now it's running the numbers. It's making 35,000 Rand per month, 29,000 Rand expenses. So the profit is positive cash flow. Number one, that's checked out. That's important. The second step is return on investment. Now this deal will bring us a 16% ROI based on the money we're putting in. Okay, so that's how we can now say, okay, I'm getting 4% in my savings account at the bank. I'm getting 16% of this property, so that means my money is going to work 4 times harder for me. So yeah, I'm willing to take the risk. It's maybe in a bit of a higher risk area, but the return justifies the risk. Step number 4, secure with an offer to purchase. Now here's a quick snapshot of the actual offer to purchase that I signed last week. And here you can see the purchaser has requested a 2-week due diligence period after signing this offer. 2, confirm raising of finance, complete a building inspection, confirming tenant's payment history and employment, Lightstone and TPN reports and area risk assessment, and the review of the annual financial statements. So all I've done here is I've said for the next 2 weeks, I've secured this price. You can't sell to anybody else. I've got this deal for the next 2 weeks. If after those 2 weeks, any one of these conditions are not met, I can leave the deal. So essentially, you secure the deal with an offer to purchase, but you put your exit clauses or your suspensive clauses in place so that you can exit the deal if something goes wrong. Let's say you pull a Lightstone or a TPN report and it says that the tenants in that area is terrible, and you didn't factor that into your vacancy provision. You can then say, listen, sorry, Mr. or Mrs. Estate Agent, the deal failed the due diligence checklist, and we're going to walk away. And the estate agent can't do anything about that. That's completely legal. So secure with an offer to purchase. Make sure you've got your exit conditions in place so that you can exit if need be. Step number 5, raising the finance. So this was the application email that I sent to Combined Finance. The signed offer to purchase. Remember, you need an offer to purchase to raise finance. I've sent them the annual financial statements, the rent roll, and I've done a financial assessment to say this is the income, the expenses, the cash flow, and essentially what I'm requesting is an 85% loan to value. So when you're working the multi-let market, you're going to be needing to use your alternative banks like your Combined Finance and your Tough, because your traditional banks are most likely not going to touch it. What you could do, and this is an interesting strategy, and I think Temba, who's on the call, is considering this approach. Now, Temba's got a property that is paid off, and he's looking at buying a student accommodation, which is basically a multi-let. He's gone to the bank. The bank said, no, we're not going to finance this student accommodation or this multi-let because it's too high risk, and whatever their reasonings were. What Temba could do is he could go get a loan on this paid off property. We call that the refinancing strategy. So the property that he's paid off, let's say it's worth $1 million, he could go to the bank. The bank will loan him on this property because this is not a high risk property for them. It's a nice 2-bedroom apartment in the suburbs. Then he could take the R1 million loan facility that he has acquired via this property, and he can invest it in to buying this multi-let. We call that the equity release. You've got a property that has equity, you release the equity, and you use that equity into another deal. So there's different ways in which you can finance it, but what I can say, just as a disclaimer, in order to do a multi-let, you need cash. Whether it's your own cash, or maybe you've got a rich uncle or family member, or you can get a couple of friends together, create a stokvel, and raise some finance, that's cool, but you need some capital. You need about $500,000, 300 to $500,000. Okay. Final step is to manage. Now, I use a company called Landstar. I by no means am recommending them. They've done for me a good job, but they've also done a bad job for other people. I think that's unfortunately always going to be the case when you're working with letting agents. What I can say is, please get a letting agent. You don't have to get Landstar, but get somebody. The point and the power of property is the passiveness that comes with it. I hope that most of you guys who joined the call today aren't looking for another job. You're not looking to buy a whole bunch of properties so that you can go and knock on all your tenants' doors and try and recover income. You bought into property because you believe in the ability to earn a passive income so that you can reinvest your time into things that you love and that drive your passion. So please, guys, I know it's an expensive fee. Letting agents take about 10% of the rent, but it's 100% worth it if they're doing all of the tasks like doing your evictions, finding new tenants, managing the renovations, collecting the rent. All of these different elements that they do allows you to buy back the most important resource that you have, which is your time. So I hope I didn't go through that too quickly. As always, there will be a recording available after this workshop, but I've been keen on trying to keep these webinars a little bit shorter, a little bit more packed, so that you can still have the rest of your Thursday evening to enjoy with your loved ones. So just before we close off, a lot of people have been asking me about how to acquire the knowledge to become a professional investor. If you haven't looked at my YouTube channel, please go and subscribe. I put a whole lot of free videos up there, constantly sharing more content, so go for it. If you are interested in stepping it up a bit and you see property as a real viable option for you to become a professional investor, please go and check out our online property bootcamp. It's essentially a bunch of online courses that we've put together. So www.propertybootcamp.coza. In this you will find there are several different courses, so things like deal analysis, where I take you through all the different formulas that you'll need, legal structures, your prop tech systems, raising finance, basically all the different elements that you would need to become a property investor. So if you're curious, go check out my YouTube channel. If you're serious and you want to learn, really the insider secrets, perhaps you want to join this course. Here are the current courses that are live: Running the Numbers, Raising Finance, Marketing, and the Property Investing 101, which is a free course, by the way, the Property Investing 101. So go check that out. That's completely free. Here's the description of Running the Numbers. It does cost 800 Rand for this specific module, and you will learn the gross and effective yield, return on investment, rate of return, return on equity, plus there's a quiz at the end to test how much of that information you have retained. Fantastic. Cool. So that's my story, and I'm sticking to it. Yeah, let's go into the questions. So I see there's 4 questions here so far. Okay, so here's a question. Tough seems temporarily closed. Is there other similar recommendations? So that's strange because Tough isn't closed. As far as I'm aware, Tough is 100% functioning. But what I can say, okay, so here's a couple of options. You've got Tough. You've got, and Tough is TUHF. TUHF is the company. Combined Finance. Sentinel Homes. SENTINEL. Homes. Another option. You can go look at the SA Property Investors Network. They have about, I don't know, I think about 40 million Rand that they're looking to invest in different deals. So that's an opportunity for you to get some financing. So I would look at those 4 options for now. Maybe one other I would say is the SAP and Connect platform. Let me just get a copy of this URL. SAP and Connect is a great place where you can connect with other like-minded individuals, where you can apply for financing with private investors. So maybe go and have a look at that one. Okay, Lebohang. My network connection is bad. Will there be a link to this video? Possibly. Yes, Lebo, there always is and always will be. So just subscribe to our YouTube channels and we'll send you those videos along the way. Okay, is rent rolls only available for multi-lets? No, rent rolls are available for any investment that you're looking at. So if you're looking even at a commercial property, one where you're renting out to businesses, there should be some sort of proof of income. So there should be an Excel spreadsheet or some sort of financial statement that says this is the income, this is the expense. So yeah, rent rolls are very common in multi-lets, but they are for all property investments. Leonie, is it wise to buy multi-lets in your own name? It's a good question. I would definitely recommend that you go and look at the most recent webinar that we hosted with Thierry. He's a tax consultant for KPMG, and he gave us some really good insights into how you can structure your property business. What I can say is that buying in your personal name only is advantageous if you have a low income, if you're a low salary earner. Because remember, as individuals, we get taxed on a certain rising scale. So low income tax earners, I think they have to pay 0 to 18% tax, something like that. And then every time you're earning more, you go up a scale and you go until eventually you're charged, I think it's 45% for your taxes. So the only reason I would say buying in your personal name makes sense is if you're in a very low income bracket. But the reality is over time, you're going to go up into a high income bracket. So I would say if you're looking at multi-lets, which is a long-term strategy, you're going to be holding for 5 to 15 to 20 years, I would say it's much better to buy it in a company. A company charges a flat rate of 28%, which is lower than your highest tax bracket in your personal name. And there's also, you get to divide or separate your liability a little bit more. So Leonie, I hope that answers your question. I wouldn't say buying in your own name is beneficial at this stage. Ronald, with the likes of Tough, do they generally finance multi-lets for up to 20 years as well, or is it more closer to commercial loans? So Ronald, that's a great question. Regarding Tough specifically, they give 15-year repayment terms, which sucks, right? It makes their financing really expensive. So Tough, the reason I would use Tough, or where I would recommend to use them, is when you're looking at buying a run-down building in the city, in the center of a town. So like Braamfontein in Joburg or Sea Point in Cape Town. If you want to buy like a rundown building, renovate it and re-establish, bring it back to its former glory, Tough is your best financing option because Tough will finance the buying of the building, but they will also finance the renovation, the materials. But they're very expensive. They charge at prime plus 3% or 4%, and it's over a 15-year period. Combined finance, on the other hand, they loan 70 to 80% at prime plus 1, which is competitive. That's very competitive, over a 20-year period. So my answer to you, Ronald, if you're looking at just a stock standard block of flats and there's not much renovations to be done, go with combined finance. Alternatively, if you're going to do a lot of work and you're going to have a big renovation budget, perhaps you're looking even at developing, Tough makes a lot of sense. Okay, Stevens, how much was your accepted offer price? So on this one, the original offer to purchase is at 2.3 million. So they wanted 2.8, we got it at 2.3, but I've got my building inspector going there this week. So I'm hoping she's going to come with a massive list of things that need to change. Then I'm going to go back to the estate agent and negotiate her down. And then also I'm hoping, or I'm going to speak to my financier at Combined Finance and ask him if he will say that they will only finance up to 2.2 million. And then I'm going to use that again as justification to go back to the estate agent. So my goal is to get it down to 2.2. At 2.2, it's a fantastic deal. It's 17-18% return. It's in a good area. Obviously, if I could get less, if you can buy it for 1.6 million, but there also has to be enough in it for the owner for them to say yes. So, yeah. Let us see. Last questions. You mentioned buying in a company. Do you mean under a trust? Okay, so Jen, what I'm going to do is I'm rather going to point you towards, again, my YouTube channel, because we had a really good webinar 2-3 weeks ago with a tax consultant who explained essentially the structures and the boundaries of your different structures. So in short, the company is good for doing property investing. A trust is good for wealth protection. So if you're starting out on your property journey, I would avoid the trusts. A trust is an expensive thing. It costs a lot of money to set up, and every single month you have to pay for the upkeep. The only time a trust is really valuable is when you have a lot of wealth to protect. Right. So when you're starting your property journey, invest with a company until you've bought, I would say, 5 or 6 properties or maybe 1 or 2 multi-lets. Then you maybe have a reason to justify getting a trust. Let me explain. A trust is going to cost you probably about 1,000 Rand per month. So if you buy one property, let's say you buy a small 2-bedroom flat and you're making 1,000 Rand profit on that deal. If you put that property into a trust, the trust's cost of 1,000 Rand eats your cash flow. You're now left with no profit. And I mean, do you really want to go about protecting one unit for so much? But if you've got 10 or 15 units that is making you 15 or 20,000 Rand profit per month, I'd be like, yeah, now it makes sense to put it into a trust. Now you want to start protecting your wealth. Okay. Let's see. This is a great question. Ronald, what is the rationale for normal banks avoiding multi-lets? Now, that is such a great question. Initially, I thought it was because multi-lets are higher risk. You've got multiple people that might not pay you, etc. That's what I thought. But I actually spoke to a guy at ABSA, and he said to me, it's a reputational risk. That's why the banks don't like investing in multi-lets. You see, if I had to buy a block of 6 flats using ABSA's money and I get liquidated or I default on my payments, ABSA needs to now repossess this block of 6 units and sell it off to recover my debt. Now, what they're worried about is what if one of those tenants goes to carte blanche or goes to a news channel and says, look at this, ABSA's kicking 6 families out of their homes. That's the explanation I got from this guy at ABSA, which I thought was crazy. It's not a financial risk for them because they can see the value in a multi-let. It makes a lot more financial sense than a buy-to-let, than one apartment. But for them, it's a reputational risk because multiple families could be at risk of being chased out, which means they could have a news story or some bad press. So that's funny, hey? That's the reason they don't want to invest in multi-lets. So in Bali, how does a rent-to-rent deal work? So simply you rent from a landlord at a certain price, and then you sublet to other tenants for a higher price. So let's say you you rent a house in a nice 5-bedroom house somewhere close to a university. You rent for 10,000, but then you sublet the 5 rooms to 5 students, and you make 20,000 rand in rent. So you're paying 10,000 to the landlord, but you're making 20,000 rand in income. So you're walking away with a 10,000 rand passive income. Again, I do have a video on the YouTube channel, so go check it out. Latashi, last one. Can you get finance with a company if the company doesn't have a trading history? From the banks, it's going to be, you can. Look, what they're going to do, before they loan you the money, they're going to say, you need to take personal surety. So you're here, your company's here. They're not going to loan to the company, or they'll loan to the company, but if the company defaults, they're going to come after you. As long as you sign suretyship, that's what they call it in the banking terms. Basically, a document that says, if my company fails to pay, you can come after me as the individual. And then the bank will loan to a company even though there isn't trading history. Of course, the terms that you might get with the bank might be worse because of that added risk for them, but you can get a loan. Okay, let's see here. Cool. Fantastic. Jen is just echoing that she's also heard that it's the reputational risk as to why banks don't invest in multi-let. It's silly for me, to be honest, because multi-lets are such a great financial asset, but the bank has to think about reputational things. Okay, let's see here. Ronald, do you not run the risk of capital gains on your shares when now transferring it to a trust? Yeah, so the strategy that a lot of people are doing, and please, I'm not an accountant, I can't give this kind of advice, but what I've got in plan for my structure is, so I've got several little businesses, and each business will have a subset of properties. And then when a business gets to a point where it's got enough properties that I want to protect it, I will then put a trust on top of that company, and I will have the shares of that company owned by the trust. So I'm not transferring the properties from my company into my trust, but rather just the shares of that company will be owned by the trust. And I'm pretty sure that's a way in which you can bypass the capital gains, because you're not technically transferring ownership of the property to a new owner, you're transferring the shares of your company. But please, Ronald, I'll just remind you to go and speak to an accountant or a professional. I definitely don't have the knowledge to really answer that, but that's how I see it. Sweet like a lemon, 10 to 7. I feel like that was a good one. I like the quicker webinars. I think the 40-minute webinar with some time for questions really works. Let's just have a look here at the polls. So most people are interested in the multi-let student accommodation vibe, and the biggest challenge for most people is capital. So for those of you who are struggling with capital, please go and check out the playlist that I'll copy it and paste it again here on the chat bar. This is a playlist of about 10 videos, I think, all talking about how to use other people's money to invest in property. Okay. What cost will you incur in transferring the shares? Stephen, I don't know. Look, you're gonna have to pay for the setting up of a trust. I think that costs about 10 to 15,000 depending on the attorney you end up using. I don't think there are any costs associated to selling shares, but yeah, you need to speak to an accountant about that. I don't know that answer. Sorry. Okay, cool. I think that's all the questions. Guys, thank you very much for being on the call today, for giving me some time on your Thursday evening. Please, please, please go and get a copy of my book or subscribe to our YouTube channels for more content. And if you are serious about getting into this property game and you want to learn a little bit more, go check out the propertybootcamp.coza. and sign up for one of our courses. Otherwise, it's been a plum pleasing pleasure and a privilege. I hope to see you soon. Happy investing. Cheers.